Joining me right now is Voltic Capital Chief Market Strategist Kathryn Rooney Vera. Kathryn, before we get to Emil, your thoughts on these emergency measures and whether or not this has stopped the panic for now?
It certainly has stopped the panic. The market has clawed back. Yes, it's slightly underwater, but we're not at the 1.5% down that we saw in the futures market just yesterday. So is this a bailout? That's, I think, a politically charged term. It really has not much, similarities to 2008. This is a backstop of depositors, not shareholders, not stakeholders, not company executives, not stockholders. And I think this is really my issue is the liquidity issue here. So companies across the board, how are they going to be able to make their payroll? It's a liquidity issue. I don't think it's comparable to 2008. I hope those comparisons aren't currently being made or won't be made because we don't need this type of panic. Maria, what I will say in addition is that this is very likely to take the Fed off of its trajectory, which I think has its own consequences. The Fed is very unlikely to hike 50 basis points. Maybe they don't even hike 25 at this point. But I think that this has stopped the panic in the market, at least for now.
Yeah. Kathryn, real quick before you go, is this the reason that we are looking at this worry? Is it all higher interest rates? I mean, obviously, the rate picture at the Federal Reserve, this string of rate hikes, we haven't even felt the true impact yet. It takes a year to 18 months for the lag. But I'm wondering, is this really the straw that broke the camel's back on Silicon Valley?
It certainly has a huge part to play, Maria, and this is part of the economic cycle. When you see the Fed having to increase interest rates about 500 basis points in 12 months, banks that have imbalances or corporations that have imbalances in what they have to pay and in the interest that they get to, that they bring in, have difficulties. So I think that high yield emerging markets, banks that are over levered, banks that have made terrible management decisions, like investing in startups that are not profitable, tech startups, et cetera, like Silicon Valley Bank, I think are going to see continued difficulties. So we should expect to see some small banks, some over levered banks, and some credits, there's interest rate risk and there's credit risk. So high yield credit, the most vulnerable names will probably see some defaults. And that's part of the economic cycle. I think we're moving into recession. I don't think that takes this off the table. I think it aggravates the risk of economic contraction going forward.
All right, we will leave it there. Ken Leon, Kathryn Rooney Vera, Emil, Michael, thanks very much for weighing in on this important subject. We've got a market that is trading nervously today.